Hey, Bowtie Nation, Joseph Hogue here. Thank you for joining us for another one of these Monday market updates coming to you live 9 a.m. every Monday, 9 a.m. Eastern. Get you ready for the market week with a topic as well as all the stock market news and trends and strategies, actually kind of alternating 1 week live, 1 week recorded. So great to be back with you after a long weekend and a couple of weeks here, and a lot to talk about this week. First we're going to talk about how the market did, how the stock market did in the first half of the year, that historic stock market crash really for all three major indexes, and what history says comes next, what history says comes next in the second half. If you should even believe it, though. We're going to look at kind of the market data over in the past, where the market is at now, and really get you ready for this next 6 months of in stocks. I do want you to, after that, though, stick around. We've got, again, all our stock market update for the week, stock market news, all the trends, strategies, really what I'm watching for this week, as well as the stocks I'm watching and all that. And then, of course, we'll have question and answer time, my favorite part of the live stream, just being able to connect with you on a more personal face-to-face level and answer your questions there. So I do want to get started, but I see a lot of people there in the chat already. All the Bowtie citizens. YouTube is now doing a pop-up and saying now would be a good time to insert ads. YouTube always trying to make money, but I'm just here to kind of connect with you guys. So let me know if I'm coming through in the chat there, coming through loud and clear, and we'll get started here. Because like I said, it was a historically bad, bad 6 months for the market. S&P fell 20.6%, which was the worst 6 months, worst way to start the year in 50 years. The Nasdaq was actually the worst ever in its history for the first 6 months. It was down something like 29%. And so really, you see all these articles, all this analysis about how the market did after that. What does history tell us? What does history tell us about what comes next? See a few comments there in the chat that people's comments aren't coming through. It does have a subscriber lock on it, so you have to be a subscriber to the channel to be able to chat. Just something that I'm trying out here. So if you want to chat, if you want to reach out to the community, make sure you subscribe to the channel and join the community there. But I want to show you a few data points here on how the market has done after that historically bad first quarter. So we're going to switch over here, and you can see the Dow is having its worst start of the year since 1962. It's actually the data back to 1921, 9 other years where the Dow was down 10% or more in the first half. You can see here that the Dow right now, 2022, for the first half was down 15.3%. It's actually the fifth worst start of the year for the Dow since 1921. You've got 9 other periods where it was down more than 10% in the first half. And on average, over that period, this second half, so this second half, July through December return here is the second column. On average, that was up 8%. So pretty good. Full year down 13%, so a little less than the average. The average for that first half was down 17.9%, down 15% so far this year. But on average, up 8% over the next 6 months. So pretty optimistic, pretty promising there. But before you rush out to jump into stocks right this morning, I want to share something else with you. The Nasdaq having its worst start to the year ever. Okay, down 29.5% in the January through June period, the first 6 months of the year. This is data going all the way back to 1971. And in 1970, data going back to 1971. There were 7 other years where the index was down more than 10%. So that tech-heavy, tech stocks Nasdaq down more than 10%, 8 times over the past 50 years, and down 29% so far. This second column is the July through December return for each of those years. And you can see here, down 8.7% in 2002, down 8.7% in 1973, down 21% in 1974. And if you come down here to the average, on average, the Nasdaq, when it was down more than 10% in that first half of the year, was then down another 6% during the second half. And in fact, if you take out this 35% rebound in 1982, So Nasdaq stocks down 12.5% in 1982 in that first half, up 35% for the rest of the year. If you take that out, then the average fall for the rest of the year was 12.7%, right? So this showing you this isn't to frustrate you, right? Showing you conflicting kind of data points, conflicting evidence of what history says. It's just kind of a reality check, right? Because you're going to see you always do see these kinds of articles, these kinds of analysis, right? What does history tell us about the stock market? And following these kinds of trends. It's really kind of futile, right, to try to draw what the stock market is going to do just because in those 7 or 8 times in the past it's done this. Okay, now you can look to similarities. They say that history doesn't repeat, but it often does rhyme, right? So we can, for example, look at times when inflation was very high, like back in the 70s. What happened to the markets then? What are the similarities between that market and this market today, and how can we draw conclusions from that? But I would warn you against just looking at charts like this and saying, okay, you know what? In the past 8 times that the Dow was down more than 10%, it was up 6% in the second half. So I'm going to be buying stocks. Don't do that because you really have to you really have to understand how history doesn't repeat and how, some of that data can be skewed. A lot of times it's so easy just to look back on history, look back on the data and kind of cherry pick what you want the data to say and the data to fit your own story rather than the story to fit the data. So we're actually going to look instead. We should be looking at where stocks are at now, right? What are the similarities with the past? Yes, but where are we at now with stocks and those main forces that are pushing stocks down? We still have inflation data. Inflation data is coming up on the 12th. That CPI, Consumer Price Index, the PCE report, which is the third set of inflation data that we get each month, that came out last Friday, and it actually was pretty good. That's the main data or the main inflation point that the Federal Reserve looks at when figuring out its interest rates schedule or interest rate hikes. And it did show significant improvement in the supply chain. Okay, so the supply chain, how we get goods from Asia and from around the U.S. to retailers and that kind of thing has been just historically broken, right? A lot of things shut down, a lot of transportation, a lot of factories, a lot of manufacturers shut down during the pandemic. That really created a backlog and a bottleneck in supply chain and caused a lot of the inflation that we're seeing right now. Well, that PCE report last Friday showed a lot of improvement in that. So there is some evidence that part of inflation could be coming down. We're also starting to see, weakness in jobs market as well as some other things. So there is some evidence that inflation could be coming down. But you've also got other inflationary pressures like the war in Ukraine, right? Between Ukraine and Russia, they are probably about a fifth of world grain exports. So wheat, barley, some of those others. Obviously, Russia is hugely important as far as oil and gas exports. So as long as that happens, or as long as that is on the table, then that part of inflation is going to be high. We've also got a few other inflationary pressures on the market. What we saw over the last couple of years with housing prices, we have not seen rent prices keep up with that. And I know all you out there renting an apartment or renting a house are saying, bullshit, my rent has gone sky high. But it hasn't gone up quite as much as a percentage as housing prices have gone. And we've looked at the data on that through the Fed tool. But we've seen like 40% increase in housing prices over the last couple of years. Only about a 10 to 15% increase in on average in rental prices. So the problem with that is that tends to be kind of lagging. Those rental prices go up slower than those house prices. So what we're seeing now is rental prices continuing to go up to catch up to those house prices, right? I mean, if you own a house, then what do? Do you live in it or do you rent it out? Well, if rent prices are way low, then you might as well just live in it, okay? And so those rent prices are starting to come up to meet that real economic cost of owning a house. and that's going to keep those inflationary pressures higher, right? So we do see some inflation coming off. We'll probably see that in the CPI report this month coming up on the 12th. We'll start to see inflation moderate a little bit over the next couple of months, but it is going to be historically high, and it's going to remain high as long as we have no resolution to Ukraine, and as long as rent prices continue to go up to meet housing prices. Based on market probabilities on this, everything, all this talk about inflation and the rest of the economy is all on the basis that the Fed is going to have to raise interest rates, right? Raise interest rates to cool down inflation, and that's going to slow down the economy. And based on market probabilities, the Fed is expected to continue to raise interest rates. I'm going to share the Fed Watch tool here with you. This is the CME Fed Watch tool. If you ever want to know what the market expects as far as the Fed hiking rates, increasing interest rates, you can go here. It's the CME group, the Futures Exchange Group, CME Fed Watch tool. And this is going to show you across the top here all the meeting dates, the next meeting dates of the Federal Reserve. You've got the July, September, November, December meetings of this year, and then even into next year. And what you do here, you see this target rate probabilities. These are all set as far as market probabilities, where interest rates are trading in the futures market, and what the market sees as the probability of where the Fed is going to raise interest rates, right? And you can see here this current target rate. It says current target rate is 150 to 175 basis points. So that's 1.5% to 1.75%. And we're here in the December meeting. So through the rest of this year, the market is estimating that the Fed will raise its target rate, its Fed's funds rate, to 325 to 350 basis points, right? About a 50% chance that it'll raise it to at least that. 23% that it'll raise it to one more hike, 350 to 375. There's a few doves still out there that think it won't get quite that high, that think it'll get to maybe 275 to 300 over here, 22%, 300 to 325. But the most of the market, the biggest market probability here, 50%, 325 to 350, which means the Fed is likely going to hike another 1.75%, right? Basically doubling where rates are now. That would take the Fed funds rate to 3.5% from basically zero at the beginning of the year, which it might not seem like a big change, but that is a huge change as far as that base rate and interest rates. To raise the interest rate 3.5%, that's really where economists say that that's where economists say that the interest rates start affecting the economy, start really dragging down economic growth, is when you get interest rates that high. And of course, 3.5% Fed funds rate, you're going to see mortgage rates at 6 and 7%. You're going to see corporate bonds and other interest rates go up, and that's all going to have that effect of slowing down the economy. And really, what the Fed wants to do is bring down its that inflation. I want to share something else with you. It was really interesting. I saw last week. This was the big shocker of last week, and not too many people were talking about it. I was kind of surprised this wasn't bigger news than it was. There is still a few economists, a few analysts and pundits out there that saying we're not going to get a recession. And I think this kind of put that to rest, right? We are going to get a recession, and we might already be in a recession, folks. A recession, technically, a recession is 2 quarters, so 2 3-month periods, right? January, February, March, April, May, and June would be 2 quarters of falling GDP, falling economic growth, right? We saw a 1.6% contraction reported in the first quarter. So in the first quarter of this year, the first 3 months, the economy fell by 1.6% on a year-over-year basis, right? That's 1 quarter. Now, this is the Atlanta Fed GDP tracker, right? Federal Reserve Bank of Atlanta does this they track different parts of the economy to really estimate the growth rate on the GDP, on the economy, right? It looks like you can read through this key indicator of economic activity. And what we see here, they've been updating this, and their latest estimate is for the second quarter. It's going to be that's the January, February, March, April, May, the April, May, June quarter, right? The second quarter is going to be reported on July 28th for them to report 2.1% fall in economic growth, right? So another quarter of contraction, that would put us into a recession. That would put us into technical recession. And you can see where it started here. We were above zero all the way up through here, through probably pretty much 27th of June through last week. And then a lot of the manufacturing data came through, a lot of the consumer confidence data came through, a lot of that data just recently that said, hey, the economy is in a lot worse shape than we expected, than we thought, and they downgraded this. And it was actually about 1.1% negative last week when I first saw this. It has since gotten even more negative, down 2.1%. And I think what's important here is, this is a forecast, so this isn't set in stone. But on data going back to 2011, when they actually started this GDP tracker, the forecast has only been off like 0.3% or 0.3%, right? So if they're forecasting an economic contraction of 2.1% in the second quarter, it's very, very likely that that's what it's going to be very close to that. At the best, maybe 1.5% contraction, which is still going to be a contraction, and we still are going to be in a recession. So, be watching for that July 28th when that official first estimate of the second quarter GDP comes out. That's probably going to be negative, and the big news is we're going to be technically in a recession. Now, of course, whether that eases up a little bit through the rest of the year and we get a little bit more economic growth is one thing. But I do think, as the Fed increases interest rates, continues to increase interest rates, that is going to weigh on economic growth. So we may get a double dip recession. In fact, we might get something where, this first two quarters we've had a recession, economic contraction. We get a little bit of a let up there in the third and the fourth quarter. But then in 2023, like we've been talking about on the channel, we get another recession, right? A double dip recession. And that's really what we're looking at for stocks, right? Even on that bear market stocks, is the big thing that I've been watching, really the next shoe to drop for the stock market and for stock prices is those earnings, right? When you look at something like the price to earnings ratio, right, which is the price of all the stocks in the S&P 500, right around 3,800 right now, and then the earnings expected to be reported by those companies, right around 230 for the index this year is what analysts expect those companies to report. And we're going to look at that here in a little bit. Then that gets you to about a 17 times price to earnings, right? We can do the actual math here. 3,800 divided by 230 for this year, that gets you to about 16.5. Analysts actually believe the S&P 500 will post $250 in earnings next year. So if we do that, 3,800 divided by 250, that actually gets us to 15.2 on that price to earnings ratio, which of course historically has been a great time to buy stocks. 15 times on a price to earnings has been historically cheap, okay? But the problem is those analysts where they're forecasting those earnings for the S&P 500 companies and really for the entire market, they haven't downgraded those yet. A lot of them are still on the fence as far as a recession. A lot of analysts, obviously, they like to be optimistic. They like to be bullish. Nobody likes to downgrade their estimates for a stock because, especially for analysts, because kind of the dirty little secret on Wall Street, folks, is that these analysts, they work for the banks, they're making these predictions for company earnings and following these companies. But those banks, they need that money from the companies in investment banking, in bond sales, in a lot of these other things. So that's why you get these perennially optimistic outlooks by analysts. Okay, if you ever wonder why analysts always say, most stocks are a buy, like 67% of stocks out there, analysts have them rated as a buy, and only maybe 13% a sell. They have these high earnings expectations, all that kind of thing. If you ever wonder why that is, it's because no company is going to give a bank its investment banking business or its bond business if the analysts are being a dick and saying don't buy that stock. Okay, so analysts are always optimistic, and that's what we're seeing. We're seeing right now analysts have not downgraded those expectations. If we look here this is the FactSet earnings insight. All you out there in the nation know I love this. I love this research, comes out every Friday. Really shows analyst expectations for this S&P 500 stocks, for the sectors, all that kind of thing. And what you can see here, this is the bottom up EPS estimates, the actuals and estimates. So this is the blue lines. The dark blue lines are the earnings that companies in the S&P 500 reported in each year. Okay, you can see here from 2012 all the way on the left, all the way through last year, 2021 on the right. Last year, earnings or companies in the S&P 500 reported $208 in earnings for that index. Okay, for that broader market index. This year, these other two lines here are the estimates what analysts expect for this year and next year. So this year, analysts expecting companies in the S&P 500 to report $229.63 in earnings. So all the companies, all those 500 largest companies in the United States reporting their earnings for this year, analysts expect that to come out to $229, right? And again, if you do the math here, you can get kind of a market-wide price to earnings ratio. With the market at 3,800, if analysts are right and companies in the S&P 500 report $229.63 in earnings, then right now we are setting at about a 16.5 times price to earnings ratio for the stock market. And that's not bad. Historically, that's been a good buy point. On average, over the past 10 years, the average has actually been about 17.5 or 18. So this would be below average price to earnings ratio, cheap relative to the average. And it gets even better. If you believe what analysts are expecting, then companies in the S&P 500, that broad market index, will report $250 in earnings over the next year in 2023. And so if you do the same math there, 3,800, which is the S&P 500 right now, divided by this 250, that gives us 15.2, which again has historically been a great time to buy stocks. 15.2 times on a price to earnings ratio is historically cheap for stocks. Again, the problem though is you see this, $208 in earnings last year, $230 this year, $250 next year. Analysts have not pulled back those expectations. And if we are already in a recession, if we are getting a double dip recession over this next year, those corporate earnings have got to come down. Data from Deloitte Touche actually says that corporate earnings drop between 10 to 20% in a recession on average, right? Analysts here, you see this, analysts here still expect earnings to grow about 10% this year, 9% next year. And that's just not going to happen. Okay, we're expecting analysts to start downgrading their expectations. We're going to start getting second quarter earnings releases here next week with the bank stocks, and then through the next couple of months, through the next month, from stocks, companies are going to start reporting their second quarter earnings. They're going to be pessimistic, just like they were in the first quarter. The big news in the first quarter was that companies were downgrading their expectations for the rest of the year for earnings, and that really hit the market. But analysts, the Wall Street didn't seem to get the memo on that, because these earnings are still very high and way too high. So what I think you're going to see again is you're going to see that haircut over this quarter, over the next quarter. You're going to start seeing analysts come out and say, okay, you know what? Companies have been saying this for the past 5-6 months, that earnings are going to be bad for the rest of the year. They're unsure about 2023. So we're going to have to downgrade our expectations. We're going to have to take this $250 earnings expectation you see in 2023, and we're going to have to downgrade that. We might even be something down 10 or 20% from this year's expectations, right? If companies report $230 in earnings this year, and we hit a big recession that drops us down 15%, that takes 2023 earnings to $200 a share, right? So if we're getting more like $200 a share in stock market earnings next year instead of this 250, then you do the math. 3,800 divided by $200 in earnings for S&P 500 companies, and you're really only at 19 times on that price to earnings ratio, right? So you really do have to look at this, because obviously stocks are not nearly as cheap as they seem right now. When we do start seeing analysts downgrade these expectations for stocks, and really lower these estimates, then I think you're going to see that stocks are not nearly as cheap, and we do need to wait a little bit longer for stocks to come down into that value territory. So now we've been talking about what to do with this, how to invest, when to invest, through this stock market crash. And we've been talking about kind of a staged approach, right? I've been talking about how, I've got about 25 to 30% of my portfolio, of my wealth in cash right now, cash and some of those other cash-like investments. And I'm waiting for, I'm set 3,400 on the S&P 500 for that first tranche, that first area. Then I'm waiting for 3,100 and then 2,750 on that broader market index, right? That would be, so that first level of 3,400 would be about 29% down from the market peak earlier this year. About 4,800 was the S&P 500 peak. That would be about 30%. The next level, 3,100 on the index would be about 35%, and then down to 2,750 would be about 43% down from the peak, right? So 3 stages where I'm going to invest some of that cash, okay? And again, what this does is it takes the stress out of watching the market every single day, wondering if now is the time to invest, and when you should put that cash to work, and how far stocks might go. It really just takes the stress out of that. You don't have to worry about that kind of market timing and that idea. It also puts your money to work at those different levels, but then it holds some of it back just in case stocks do keep falling. Now to this, I actually want to add kind of an ETF fund strategy, right? Again, as the stock market falls down to these levels and you start investing some of your money back into stocks, it's not necessarily all in the stock market. You want to invest in the companies that you like, the companies that you're going to hold for the next 5 or 10 years, as well as some of the ETFs, the funds in your portfolio. You're not investing in the entire stock market itself, unless that's one of the funds you own, like the VTI or the VOO, one of those broad stock market funds. So with this ETF investing strategy, what I would probably do is, if the S&P falls to that first point of 3,400, then maybe I would buy more value stocks, right? More value stocks, funds. And the reason is, if the stock market does continue to fall, those value stocks, they're already in value territory. They're already cheap relative to growth stocks. Some of the other parts of the market, they're paying dividends usually. So they're probably going to fall less than a lot of these other stocks. This is the big. Obviously, Warren Buffett is back in the news because his investing strategy, that value investing strategy, has actually come back from the dead and is really outperforming the market. Okay, over the last 10 years, Warren Buffett's value investing strategy has actually lagged the market. If you look at shares of Berkshire Hathaway, they've lagged the market over the past 10 years. Growth stocks, tech stocks, a lot of those faster growing stocks and themes, growth investing has really outperformed. This year, though, those value stocks have come back. They're down maybe something like 7.5%, 8% this year, while the rest of the market is down 20%. Okay, and it's because, yes, value stocks tend to lose less in a stock market crash. So as the stock market falls, it hits that first buy point of 3,400. I would be looking at buying more value stocks and more value stock funds instead of maybe getting more into those growth stocks. I would wait until maybe that second point, 3,100 on the S&P 500. Then I would go maybe into a little bit more dividend stocks. And there is a lot of overlap between dividend and value stocks. Value stocks tend to pay dividends as well, so there's going to be some overlap there. But I would still be a little more wary about adding too much in growth stocks, right? Because if the stock market does continue to fall, those growth stocks are going to continue to be the ones that get hit harder. Okay, you look at an index like the Nasdaq, which is tech-heavy, very growth-heavy index, is down almost 30% so far this year. From that peak, the S&P 500 only down about 20%, and the Dow, which is much more value and dividend stocks, is only down about 15%. So if you do want to add something like some kind of a strategy, an ETF strategy like that to your buy points, I think that would be a good idea, right? So starting off with more value stocks, more dividend stocks, eventually as the stock market does hit that 45% down from the peak, 40% down from the peak, I think you can start getting back into these growth stocks because at that point they're going to be terrifically underpriced and ready to go. So I want to turn this over into the stock market update that we're watching. Just some stocks I'm watching this week, what to watch this week, and then we'll get to the question and answer. The big news of the week doesn't come until Friday, really the Friday monthly jobs report. So we're going to see the June jobs created here on Friday of this week. And economists are expecting a pretty bad number, right? 390,000 jobs created in the prior month in May in the United States. They're only expecting 250,000 jobs to have been created last month. Okay, so we are starting to see the effects of higher interest rates. A lot of companies slowing down their hiring, even some companies even rescinding job offers, which is kind of a real kick in the nuts, right? You think you got this great job lined up with Google or Facebook or Tesla or wherever, and then all of a sudden they say, you know what? Hey, look, we're not going to be able to hire you like we thought. So good luck with that. So a lot of companies doing that, rescinding job offers, and really it's just kind of a stepping stone until they actually start laying off people. Okay, so a lot of companies looking towards a recession, lower demand, and that kind of thing, and they're going to be slowing down their hiring. So we are expecting just 250,000 jobs created last month, unemployment to remain at 3.6%. So the jobs market will still be fairly strong. 3.6% is historically one of the lowest unemployment rates we've seen. Jobs creation of 250,000 jobs is still very strong. Now, there is a good chance that the number of jobs added does come in under that, does surprise to the downside, and is likely to get worse over the next few months. Again, we've seen the economy slow down. We are probably technically in a recession already. Companies know that. Companies see that in their own demand and their own sales, and they're going to start cutting workers, and they probably started cutting workers last month. And that actually might be something like good news, right? We're in a situation where a bad jobs report, bad news for the jobs market would be good news for the stock market, because again, it would say to the Fed, to the central bank, that hey, those higher interest rates are working, they're slowing down the economy, and that's going to bring down inflation, and your job is done. You can start, don't raise rates quite so much, because we're going to see the economy slow down already. So I would expect that there isn't too much else. Holiday shortened weekend, obviously. Markets closed yesterday for the 4th of July, Independence Day. We do get the release of the Fed minutes from the last Fed meeting this Wednesday. It's really kind of an afterthought, though, because Chair Powell and the rest of the Fed members have been very good at kind of previewing what they're going to do, what they're going to say as far as raising rates and that kind of thing. So we really know what they're thinking already. We don't really need the minutes quite so much to know where the Fed is thinking. With investor sentiment still negative, with inflation still historically high, it is going to be a while before stocks, I think, start that next bull market, start that next trend. So again, I would be looking for those points on the S&P 500 to start deploying cash, but waiting for it to come down a little bit more. I want to turn it over to kind of some of the stocks I'm watching this week. First let's look at what the sectors did last week. Give you kind of that big picture idea, big picture outlook on the stock market. Here again, we're at the sector tracker on the sectorspider.com. Great tool. Always use this tool every week just to get that big picture, what the stocks in each sector are doing over the last week. You can look at last month, last 6 months, year to date, that kind of thing. And again, of course, we did see, the stock market fall 2.2% last week. That big rally on Friday wasn't enough to turn it positive for the week. Looks like the market is going to open negative today for this week. But we did see 4 of the 11 stock sectors close higher last week, with energy really joining those traditional safety sectors, right? Consumer staples, healthcare, utilities, all 3 of those traditionally safe sectors. Consumer staples, those things like food, packaging, household products, people have to buy those in a recession or not. So those stocks were up 0.5%. The healthcare, obviously people need their drugs, people need their heart medicine when stocks fall, and probably even more a little bit when stocks fall. That was up 1/3%. Utilities, the big outperformer last week, up 4%. So those gas and electric companies really doing well through a recession. And of course, energy. Energy stocks have been the outperformer all year this year with those higher energy prices, higher oil prices. Now, what I will say on that, we've been talking about the higher oil prices, the energy stocks all year this year. Obviously, as we get lower economic growth, energy prices or oil prices are going to be coming down. Okay, if we reach any kind of a settlement in Ukraine, any kind of a resolution, any kind of a talks, then oil prices will come down. The thing we got to remember, though, is even at $70 or $80 per barrel on oil, a lot of these energy stocks, a lot of these energy companies are still very profitable. They are still cash flow machines, and they're still going to pay out those dividends. They're still going to be buying back their own shares. So energy should still be a fairly good sector for the rest of the year, I think. And of course, we've talked about this before. It's kind of a balancing act for your portfolio as well. As long as we have high energy prices and those energy stocks do well, then inflation is probably going to be a little bit higher. So, your energy stocks are going to do well, but the rest of your portfolio might lag a little bit. If those oil prices come down, though, then your energy stocks are probably going to sell off a little bit. But inflation will come down and the rest of the market will probably be a little bit stronger. So, it's kind of a balancing act. Have some energy stocks in there. They could come down, but they're going to provide some great dividends and a balance to that rest of the risk in your portfolio. Now, stocks in the consumer discretionary sector, big trend so far this year. They're getting slammed this year. Really, we can come out to the year to date. So this is how the sectors are doing year to date. Stocks and consumer discretionary. So all the things we love to buy but don't necessarily need to, like fast cars and clothes and things like that. It's been getting slammed down 31.5%, worst performing sector so far this year. And it's really, as the market is taking bets on when those first retailers are going to declare bankruptcy, right? Which ones are going to declare bankruptcy as the market slows. Between high inventories that really have to be discounted. We got a lot of news from Target and Walmart over the last quarter saying, retailers have so much inventory that they can't sell. They're going to have to discount that. They got higher transportation costs, higher employee costs, and really a fear of a slowdown is really dragging these consumer discretionary stocks down. So it's not looking good for the sector. I think there are some opportunities here. You look in here and you pick out the names that are going to survive. The best of the best retailers. You kind of bite your tongue and hold your breath and invest in some of those long-term investments, because now down 31%. They could fall another 5, 10, 15% even, but eventually these stocks will rebound, into the next bull market, and they're going to be strong. They're going to be strong plays into the next bull market. I want to look at a few of the stocks I'm watching, and again, it's a really short, not a lot of news this week as far as stocks and stocks to watch. There's not a lot of earnings until we get to next week. One thing I am looking at is the semiconductor stocks got slammed last week. All the semiconductor companies really plunging last week. 8 of the worst 10 performers in the S&P 500 were in semiconductors group. That's how bad it was last week. Micron really came out and guided full year earnings lower on really weak consumer demand and that even an easing of the chip shortage, right? Analysts at Bank of America lowered their outlook on the group and warned that a recovery is unlikely this year. Okay, and what we're really looking at in semiconductors here, obviously that processing power inside of computers, inside electronics, is really the slowdown in computer demand, PC demand. We had a surge in buying through the pandemic. People upgrading their PCs. Their computers, their notebooks, their laptops, things like that, while they worked from home, had a surge in demand during that period, and now that's coming off. Okay, people don't need to buy a new computer every single year, so we're getting really weak demand for electronics in a recession, or really weak demand for computers and PC and laptops and that kind of thing. So we're really seeing a slowdown in semiconductor demand and semiconductor stocks. Again, that's probably not likely to get any relief this year, especially with the worsening economic backdrop. So I would be avoiding semiconductor companies here. Shares of Micron, shares of Intel, AMD, all of those, even Nvidia, even one of the the strong growth stocks over the last couple of years. Nvidia, seeing some very slow sales because of the fall in Bitcoin mining, Bitcoin prices, as well as other semiconductor companies. Home builders last week. Home builders actually got a little bit of a reprieve last week. Rebounded. All 3 stocks, Pulte Group, D.R. Horton, and Lennar, all 3 stocks up more than 5% last week. And again, remember, that was against a market that was down 2%. So outperformed the market by 7%, and some of the top 5 gainers in the S&P 500 index. Group had fallen really hard over the last month on analyst downgrades as mortgage rates increase, and we really started to see a slowdown in housing. But Lennar really came through with better than expected Q2 earnings, affirmed its rest of the year guidance, its Q3 earnings, and profitability looks like it's holding up. So, if we do get a lower 10-year treasury rate, like it's looking like we are, mortgage rates might actually come down or might at least level off over the next couple of months. And that would be good for mortgage demand. That would be good for, the housing market and for home builders. So I'd be watching the home builders as well. I want to switch it over to the question and answer period now. I'm going to go back through and see what we have for questions. Favorite part of the live stream every week. So I'm going to scroll up here. What do we got here? See a lot of great, a lot of citizens of the Bowtie Nation there. Good to see you there. Melanie Struck, Melvin Master, Quincy K. Good to see you all there in the chat. Okay, what do we got? Ivan, good to see you. Good to see you. It's been a while. Michael, good morning from Florida. What else? Trying to find a question here. If you do have a question, make sure you use a question mark so I know that it's a question. I can see it pretty easy here in the chat. D budgets. Hope best time to invest if you plan on holding the next 50 years. Okay, so yeah, Cameron says it's the best time to invest if you plan on holding the next 50 years. Well, yeah, I mean, I don't know how many people have a 50-year time horizon, but yeah, historically, what we have seen is people that have waited for a 20% drop in stocks, which is what we've seen in the S&P 500 so far, have gotten about a 70% average return over the next 5 years. Okay, so that's about 11% annualized return. So yeah, I mean, while I do say that stocks aren't quite as cheap as a lot of people think they are, there's still probably more down days than up over the next 6 months. If you just want to put your cash to work and don't want to worry about it, then it's not a bad time to invest, right? If you want to put the cash to work and not have to worry about the market timing, then you should be good, especially over the next 10 or 20 or 30 or 50 years. You see that? So reset. What else do we have here? Please support the channel. What else? Still looking for questions here. I mean, I love that we got lots of comments there in the question. Talk amongst yourself. There you go. Who are we kidding? SB below 19 is a bite your hands off deal. Okay, so not Enrique seems to think that the S&P PE ratio below 19 is a bite your hands off deal. Not really. Okay, I mean, folks, I'm sorry, but a lot of people that just started investing over the last couple of years have really been, in a market where, the S&P 500 hit like 35 times on a price to earnings ratio last year. But that is not something that happens ever, right? Let's look at we can actually look at where the S&P 500 has been in the past. I want to show you this chart. This is the forward. So let's change this. Okay, so this is actually a chart. This is in FactSet Earnings Insight. Again, the S&P 500 trailing 12-month PE ratio, okay, over the past 10 years. So what you see here is the PE ratio for stocks in the S&P 500, that broad market index, over the past 10 years. And you can see, over the past, last year, right around March, it hit 35 times on a price to earnings ratio. So you look at stocks now and you say, wow, 19 times price to earnings ratio, that is terrifically cheap compared to that. Well, yeah, but you got to look at where that was. I mean, that was just ridiculously expensive on a historical basis, right? If you look further out, the 10-year average, which is this blue line, this blue dash line, it is right around 20 times. The 5-year average right around 23 times, which is that green dash line. And the problem with this chart, it only goes back 10 years. The last 10 years have been a historically strong bull market. Okay, so you can't necessarily take these numbers and say, hey, a 20 times PE ratio would be great too. Because it's just not. Okay, the last 10 years have been historically low interest rates, have been historically easy money policies by the Fed and the and the federal government. Have just been, we had that tax reform in 2017 that really boosted earnings for stocks, really boosted the outlook for companies and corporate earnings. So the last 10 years, you've had a historically great time for the markets and for stocks, which of course is obviously going to improve investor sentiment. It's going to improve how much investors are willing to pay for those earnings, and hence that higher price to earnings ratio over the past 10 years. If you could scroll out here and go back to, maybe 20 or 30 years, I recommend usually you going back to right around 1960s, 1970s to get a better long-term picture of that price to earnings ratio. And what you see there is the long-term average is closer to about 17.5, 18 times price to earnings ratio, about the average. But then if you do look, you see 15, 14 times on those bear market crashes that have historically been good times to buy stocks. So I would not say that 19 times is a good deal. I would wait for it to come down to at least 17.5 times, maybe 17, 16 times on a price to earnings ratio to really start getting excited about stocks. That's just how it is if you look further out onto this stuff. What else? How do you feel about AMC? Okay, Rec Tonight wants to know about AMC. I'm sorry, I know it's a lot of people love AMC, love GameStop. A lot of these meme stocks think that they're going to make them rich, but these are zombie companies. But these are zombie companies. They do not make enough earnings. They do not make. Some of them don't even make enough sales to cover their interest expense. Okay, and that's really the definition of a zombie company. Okay, any company that doesn't make enough EBITDA, right, earnings before interest, taxes, and depreciation to cover its interest expense. Okay, and you got to look at how much debt these companies over the past 3 years, just to survive the pandemic, have put onto their balance sheet, and now how much interest they owe every single quarter, every single year to pay off that debt, right? And a lot of these companies, they're just not covering that interest expense. So they are technically zombie companies. With interest rates rising, it's going to make that debt even more expensive, and it's going to make it even harder for these companies to survive. And we're not going to be getting bailouts of a lot of these companies because that would really defeat the purpose of what the Fed is trying to do with raising interest rates, slowing down the economy. So a lot of these companies, especially something like AMC, with streaming now available, there's just look at the box office receipts, box office sales for a lot of the movies coming out. Top Gun did very well. Doctor Strange did very well. Spider-Man obviously did very well still. But you look at the box office receipts for these movies coming out, and even the ones that do well are still nothing like they did before the pandemic. Okay, people are still just not going back to the theaters because of streaming, because of that streaming option. So AMC, a lot of these other movie companies, they're going to be bad luck for the next year at least, and could file bankruptcy. So a lot of risk there in AMC, a lot of risk in a lot of these other companies that were meme stocks or really hot stocks during the pandemic. Okay, Hunter wants to know if I think oil can hit $150 by the end of the year. No, probably not going to happen. Now, the only way that would be possible if the Russia escalated the war in Ukraine, really pulled out all of its oil. But the problem is, even with that, even if Russia isn't selling its oil on the global market, to Europe and to the U.S., it's still selling to India. It's still selling to China, which are two of the largest buyers on the market, right? So that oil is still being sold. It's still technically on the global market, even if it's not going to Europe or the U.S. So even with an escalation, I don't see oil at $150. The big thing for oil right now is just that slowdown in economic growth, right? As we look to a recession this year and next year, slower economic growth in the U.S. and Europe and across the world, then you just don't need as much oil, right? The oil demand is coming down. So there's no way oil gets up to 150. I doubt that it even goes up even past 120. Even with an escalation in Ukraine, could jump back up a little bit, but I think oil is kind of topped out here at $110 a barrel. Not to say that those oil stocks aren't still good buys for that dividend and for that cash flow, but yeah, I don't think it goes much higher. What do you think about companies like Western Union? Where did that go? Saw somebody asked about Western Union, but I scrolled through and missed it there. Western Union. Okay, there you go. Omari wants to know, what do you think about companies like Western Union during a recession? Now, like Western Union or Western Union itself, I don't know. So Western Union itself, I think, those old school traditional money companies like Western Union, MoneyGram, things like that do those international transfers, things like that. I think their days are numbered, right? It is so much cheaper to do it by do it by cryptocurrency, do it by Bitcoin. And I know Bitcoin isn't as popular now as it was last year, but it is still very seamless, very fast, and very cheap to send Bitcoin internationally and save a lot of money, as opposed to Western Union, as opposed to MoneyGram, as opposed to some of these. So I would be worried about those companies specifically, whether it's a recession or not. We have talked about some good recession stocks in the past. So, look through some of the videos over the past few weeks. We've been talking about recession proof stocks. Obviously, not stocks that are going to get hit nothing, that are going to do really, really well during a recession, but stocks that are at least going to protect your money. You've got things like auto parts that do very well. You've got the drug makers. Obviously, people need their medication in a recession or not. So you've got auto parts, you've got drug makers, you've got the discount stores. The dollar stores tend to do better in a recession, right? Tend to hold up better. Now, again, that's not to say that those stock prices might not fall a little bit, but they will fall less than the rest of the market. So, you got your dollar stores, your discount stores, things like that I would be watching for a recession. Do well in coming months. Okay, Ned BR wants to know, do you think the financial sector will do well in the coming months? Higher interest rates, less new loans, but better performance on variable interest rates. So yeah, financial companies, banks specifically, is something we've been watching over the past 6 months. They've been hit hard. They have underperformed the market just because, obviously as the market looks towards a recession, they're going to think, okay, loan defaults are going to start going up, loan demand is going to start coming down, and that's going to hurt the banks. The problem is, a lot of the underlying economic factors are really strong still for the banks. Okay, consumer and small business deposits are still up. JP Morgan first quarter earnings showed that small business and consumer deposit accounts were up something like 10 or 15% year over year. JP Morgan CEO Jamie Dimon actually said that consumers had about 6 to 9 months of savings, excess savings still in their accounts, to be able to spend. So the consumer is still strong. The small businesses are still fairly strong, even though we do see the economy weakening a little bit. Loan defaults are still low. The banks have actually started in Q2 and Q1 have started moving some of their earnings into that loan loss provisions account, right? That kind of what if, oh shit account, that if loan defaults do come down, they can take this cash money that they've got set aside and say, okay, you know what? We're covering our earnings, so we're still going to make those earnings expectations. So banks have already started to adjust for an upcoming recession. So I don't think it's going to be quite as bad as that. Obviously, we do have interest rates going up, and that's good news for the banks because they make more money on their loans, on their long-term loans. So I actually really do like the banks. I'm actually just recorded a video. It's going to be out probably into this week on bank stocks, adding some bank stocks to the portfolio, to our 2022 portfolio. We've already got Citigroup in there, adding Wells Fargo back into the portfolio. Had 71% gain on Wells Fargo last year before we sold it. Citigroup was up something like 80% before it started falling this year. We're gonna keep Citigroup. We're gonna add Wells Fargo. We're keeping Citizens Financial. But I'm also going to add JP Morgan and Bank of America. Okay, so look for that video, why we're adding those, and the outlook for bank stocks for the rest of the year. Okay, what else? Roman Lechuga wants to know about Smile Direct Club at ticker SDC. And I don't know about Smile Direct Club. I know it's obviously orthodontists, dentists, and actually really interesting to saw some data in Wall Street Journal last week that the spending on dental services is actually down like 11% from the pre-pandemic, which was really surprising. Some of those companies, those dental companies like Invisalign, which is Align Technology, did really well during the pandemic. but actually spending on dental services is way down. So I don't know quite why that is. I didn't look into it just yet. And I know a lot of these dental companies are way down from their peaks during the pandemic. Smile Direct Club probably as well. I would wonder, I mean, dental services, it's something that most people need to buy anyway, right? So if spending is so much lower, then I would wonder if there's going to be a snapback, if eventually we're going to get a rebound in dental services spending and boost these stocks back up. So I would be looking at these stocks. I haven't looked at them yet. I haven't seen what the valuations are on them yet, but I would be considering that. Consider. Okay, so where dental services spending was, pre-pandemic, during the pandemic, and then now, and kind of see where that cycle is, and so it kind of gives you an idea of that market timing of, buying the stocks as the consumer spending in that space is lower, and it's kind of that cycle low. So good question there, though. Okay, our blue light special. So yeah, Joseph says a lot of big names. Big name companies have hit a 52-week low. Kmart blue light special. Yeah, not quite. I do think there are already deals in the market. Even some of the growth stocks, that I think have farther to fall if the rest of the market falls. There are some good price to earnings ratios out there, some good valuations. But I would be hesitant because even if a stock is a good value now, if the rest of the market falls, it's going to fall as well. So I do think you get better prices later on. What else? Okay, Classic Soul wants to know about thoughts on clean energy stocks moving forward. So, for example, the ICLN, the main ETF there, the ICLN ETF for clean energy stocks. I do like them. They're getting hit hard, which is kind of surprising. Right? And alternative energy, clean energy is kind of in a tug of war right now, right? One, oil prices are high, energy prices are high, so the alternative for that should be high as well. Clean energy stocks, clean energy, solar energy, things like that should be higher because as an alternative to high oil prices, right? The problem is a lot of these stocks, they are those classic growth stocks, right? Where they don't produce much cash flow right now. All the cash flow is in expected future cash flow, right? So as interest rates go up, you discount that back for valuation on a discounted cash flow kind of valuation, and that cash flow becomes less valuable, right? So it's the same thing we've seen through all the growth stocks this year, those valuations coming down and the stock price is really getting hammered. So again, though, I would think, with oil prices high, they've got a little bit more of a tailwind as far as just business demand. They've also got, that great long-term demand for those companies. So I would be looking at, clean energy stocks, even that ETF, the ICLN, be looking at that. I think it's a good long-term bet. And good prices right now. Again, that's not to say that the prices aren't going to come back, continue to keep coming down. Again, because if the market sells off, those growth stocks are going to get hit harder. They are going to continue to get hit harder than the rest of the market. So they are going to sell off. So I do think you maybe wait till that third tranche or that second tranche of buying to add those to your portfolio, or to really start buying more in. What else? Scanning the stocks, but I'm nervous about getting into stretches and strangles. So GameWiz just got into stocks, but I'm nervous about getting into stretches and strangles. So I'm assuming you're talking about options there with like strangle options and those option strategies. If you're just getting into the stocks, spend some time in stocks first. You don't need options. And even if you do use options, I would use them as a hedging bet, selling covered calls, buying protective puts, really, just kind of legging into options trades and options investing rather than trying to just wow the market, trying to beat the market, with 20 or 30% returns on some of these really exotic options strategies like strangles, like spreads, things like that. I think the low point in the overall market might be next year. So Jeffrey wants to know, do you think the low point in the overall market will likely be next year? It's a great question because, yeah, we are looking for those different price points in the S&P 500, those price points lower. But when do we get that, right? When does the market finally hit that low? And we can actually say, okay, you know what? This is probably it. And for that, what I am looking at, around October, September, right? You want to look for a few things, right? You want to look for those earnings expectations to come down. Okay, you want to look for analysts to downgrade their earnings expectations to, right around 200, 220 next year, 210, right? So you want to get a consensus that, yes, we are in a recession. We're going into a recession. Analysts are lowering their expectations. That's going to bring stocks down, right? And so that's when you start to see where valuations really are going to be, okay? So once you start seeing those valuations or those earnings come down, those earnings expectations come down, and then you start seeing prices come down, stocks come down further, and then you can actually say, okay, yeah, you know what, we really are in 15, 16, 17 times price to earnings ratio rather than kind of inflated where we are now with earnings expectations. So you start to see a little bit clearer picture on those actual valuations. You can be a little bit more confident that you're buying in at lower prices, that kind of thing. That's one thing you want to look for. Another thing is we really do need to see a moderation of inflation over a few months, 2 or 3 months in that CPI report, in that PCE report. Inflation coming down 1 or 2% at least, and that's going to be the key signal that the Fed might be able to slow down its interest rate hikes. Okay. So I would say, if that happens before October, then and stock prices start coming down or come down further through October, I think we've got a good chance that the market starts to say, okay, you know what, for this September meeting of the Federal Reserve, maybe they're going to start saying, you know what, hey, we've seen the economy slow down, we've seen inflation come down, we're going to slow down a little bit on our Fed rate hikes. Okay, we're going to slow down on our rate hike cycle, maybe preview even a pause eventually in the future, and that's going to be the big turning point for markets. Okay, is when you do start to get that news and the expectations that the Fed will start slowing down its rate hikes and kind of end that rate hike cycle. Okay, that's going to be your signal that the market really has bottomed and can start heading higher on confidence and investor sentiment. But I don't think we see that until probably October. If inflation hasn't started coming down, if the economy hasn't really started coming down, then maybe even through October, September, and later. But probably towards the end of this year, I would say. Unless inflation is extremely high. If inflation stays, CPI right around 8%, 7.5% or higher through the rest of this year, if PCE stays as high as it is, then yeah, it'll be well into next year before we see that come down, because that means inflation is going to be very persistent. It's going to be around for much, much longer, and and stocks are going to get hammered really for the longer term. So that's really what you need to be looking for. Inflation signals that the Fed is done raising rates and that kind of thing. Options, minus stocks. Okay, what else do we have? Trees need CO2. Can you go over stock split? Daniel Mosley wants to know about stock splits. And basically, stock splits are real popular lately, obviously with Tesla, with Apple, Amazon doing their stock splits. It really changes nothing about the company, except it is good for investor sentiment. It is good for investors that don't have access to fractional shares. Basically, what it does is, a company has, let's say, 1 billion shares in the market, traded, in the market. And for each of those billion shares, that is a one billionth ownership of that company, right? So you own 1 billionth of the earnings, future cash flows, all that kind of stuff for the company, right? Well, what happens when, and so, the expectation of those future earnings is where you get the stock price, right? You get how much investors are willing to pay for that part ownership and those future earnings. Okay. And that's where you get the stock price for those billion shares and spread the market value of that company spread across 1 billion shares. Now, when a company splits its shares, basically what it's doing, it's just doubling or tripling its number of shares. Okay, so whereas that company had 1 billion shares issued and out in the market before, now it might have 3 billion shares, right? So you still have the same exact company though. You still have the same Amazon, the same Tesla, the same Apple, the same market value of all that company, but now it's spread across 3 billion shares instead of just 1 billion, right? So the stock price comes down by a third, or comes down by, a fifth, or however many times they increase that number of shares, really, right? Well, you'll see a stock split like a 5-for-1 stock split, right? Which means they'll have 5 shares for every 1 share previously. So if they had 1 billion shares previously, they'll now have 5 billion shares. And all that market value of the company is going to be spread across 5 billion instead of 1 billion. Okay, if you've got 1 share after the stock split, you'll have 5, but you'll still have the same company. You'll still have the same percentage ownership of that company, right? Instead of 1/1 billionth of the company, now you'll have 5 billionth of the company, which is still 1/1 billionth, right? So you still own the same amount of the company. All the investors still own the same amount. So it really changes nothing about the company. And in the past, a lot of times what we've seen is, the stock gets a little bit of a bump going into the split and after, but then it comes down to that same value, right? That same pre-split value. So now what I will say is, and what we've been seeing is that, because not all investors can afford a $1,000 stock, some brokerages don't allow fractional shares, don't allow you to just invest whatever amount. You have to buy a whole share. So that does open up the investor pool to those companies, right? More investors can buy those stocks. So it is a little bit of an upside, a little bit of a tailwind for those stocks. What I would say though is just to not even consider it. If you're buying a stock, not even consider the stock split. Invest in the stock because you think it's a really great company, a great long-term investment, a really fundamentally strong company to buy shares in. Not because it's splitting stocks or doing any of these other financial magic hocus pocus kind of stuff. Okay, invest in the company itself, not in what it's doing with the shares. But good question there. What are the best interest stocks? What else thinking about bank stocks? How do you feel about SoFi? And I missed it. I scrolled through. Okay, there we go. So War Dog Ghost wants to know about bank stocks and SoFi particularly. Now, I really like SoFi. It's one of my largest positions, actually. SoFi Technologies. That's ticker SOFI. Been investing in it since really February of this year. So started buying it really after it really sold off from last year. A lot of these growth stocks really selling off, taking 70, 80% down, but now in fairly good value territory. SoFi in particular is really, got a great leadership in fintech, in online banking. Okay, SoFi is one of the few companies that has an actual banking license. So that traditional banking license that means they can offer savings accounts, checking accounts. They can get access to low interest rates like the regular traditional banks. Whereas a lot of your other online banks, your fintech companies, don't have that banking license. They don't have access to that, and they can't offer some of those banking products, right? So it gives SoFi a real competitive advantage. It's a growth industry. Obviously, any growth stocks or any growth industries are getting hammered right now just because of the increase in interest rates. The market is coming down, so those stocks are getting hammered. But you got to look longer term. You got to look at the growth industries that are holding up, that are going to be promoting all stocks in that industry, that are going to be supporting all stocks in that industry. You got to look at the best of breed, the ones with the competitive advantage in those industries, and you got to go with those, right? You just kind of got to hold your breath and invest for the next 10 years, right? So that's why, yes, I do own shares of SoFi. I think it'll be a great investment over the next 10 years. Okay. Crashing don't seem that great. Okay, so AMC Panda says bank stocks in a crashing market don't seem that great. Someone coming from someone called AMC Panda. You can't. I'm sorry, but you can't tell if a stock is a good investment by looking at its past stock chart. Okay, just because a stock has fallen doesn't mean it's still not a good company or good fundamentals, folks. You really got to look at those fundamentals, the economic backdrop behind these stocks and behind these industries, and really invest for the future. Okay. Like I said, the banks are still sitting very strong. They just passed those Fed stress tests last week that said they could increase dividends. We actually saw a lot of the banks increase dividends. Just the largest U.S. banks, J.P. Morgan, Citigroup, some of those other banks estimated to return $18 billion to investors this year through dividends and share repurchases. Wells Fargo increased its dividend just last week. So, the banks are still very strong, okay? And if the recession is fairly moderate, like what we're expecting, the banks are going to do well, okay? And what you got to understand is you can't wait for those first signals of the next bull market to invest in bank stocks, okay? Because those interest rate sensitive stocks, like banks, like real estate, those very sensitive sectors and industries to interest rates, those are going to be the first to rebound in the next bull market. Okay. As we start getting signals from the Fed that it's going to stop or pause its interest rate hikes, you're going to start seeing these interest rate sensitive sectors and stocks really take off. Okay, and that includes the banks. So if you're waiting for the stock chart on banks to start looking better, you're going to be behind the curve. You're going to have missed out on a lot of the rebound. You really have to be ahead of that, to be able to invest in those. Okay. Can we hear some news about BTC? Ivan wants to know about BTC. Sure. It's obviously been a tough year for Bitcoin, for all the cryptocurrencies. I'm still invested in Bitcoin, Ethereum, Cardano, and Polygon, right? Matic, the Matic token. And what I'm looking at is coins that have real utility value, coins that are actually used in something. Okay, you've got Bitcoin used in international transfers, in a lot of different, uses. Ethereum, Polygon, a lot of those, some of the bigger ones there, used in that decentralized finance, used in smart contracts. Coins that actually have utility value. Those aren't going away. Those aren't going anywhere, right? You're going to get a shakeout of a lot of these other coins. The coins that really aren't based on anything except people just throwing their money at it, hoping they get rich. Okay, they actually call them shit coins, right? Because they're just not based on anything. Okay, so I would really be worried about a lot of those. As the market continues to fall, you're going to see cryptocurrencies fall further too. Okay, so just like some of those growth companies, those growth stocks that might be at good valuations, they might be great long-term companies. The companies are still the same, even if the stock price has come down. You've still got a great long-term outlook for Bitcoin, for Ethereum, for these utility tokens. But that's not that's nothing in a market that continues to sell off and investors continue to lower their mood and their sentiment. So you probably, I'm waiting to see Bitcoin probably around 17.5, maybe even 15,000 to really start investing more. I don't think it goes much lower than maybe 15,000, 12,000 at the lowest. Again, you just kind of got to, with some of these, you just kind of got to hold your breath and invest where you think that around that low is, or wait for different prices. Okay. Because again, I think, the long-term outlook for Bitcoin, for that blockchain technology, is very strong. We've actually saw last week, I think it was, the SEC denied the GBTC transition to a spot ETF, right? So the Bitcoin Trust wanted to transition from a trust company into a spot ETF, which obviously would open it up to a lot more investment and make it a little bit more legitimized. But the SEC again denied that application. Well, the Grayscale turned right around and sued the SEC like they've been saying they were going to, because the SEC really, they're really not giving anyone a fair chance on these spot ETFs. So they turned around, they sued them. There's a good chance that gets resolved. It's actually expedited. I think we're expecting a court decision. I think it goes straight to the appellate court, and I think that decisions could be expected right around September, October of this year. So we could actually get some good news on that. And really, it's just progress. It's progress in that direction to getting a spot ETF, and I think that's the next catalyst really for Bitcoin and for cryptocurrencies, is getting that ETF. Longer term, we do see a halving cycle in, I think it's 2024, that has historically been good for Bitcoin prices. And then just longer term is just that adoption of the blockchain. So, I mean, just like investing anytime stocks are down into a stock market crash, it's painful, it's uncertain, but you have to look at those longer term fundamentals and the use of the technology, that industry, and you really have to invest for that, right? So again, Bitcoin at 20,000, it was at almost 70,000 just last year. I think it gets back up to that point over the next couple of years, gets back up to maybe even 100,000, even higher. And if you look at that, I mean, where else are you going to get a 5x return? You're not going to get it in stocks. So where else do you get a 3 to 5 times return on your money? So I do have a pretty good portion of my investments are still in Bitcoin and Ethereum because I do think it gets back up to that point. Again, it's uncertain, but that's just the price you pay for that kind of a return. Okay, is there a good chance to time the market? Or is it just another crapshoot? Okay, Brian B. Brian B wants to know if it's just a crapshoot trying to time the market. Is there a good chance of trying to time the bottom, that kind of thing? And really, that's the idea behind waiting for those different points in the market to start investing. Because nobody can time the market perfectly down to the bottom, right? So I'm waiting to 3,400 to 3,100 to 2,700 different buy points in the market. Will any of those be the absolute market bottom? Probably not. But I will put my money to work at different parts while holding some back to invest later. Okay, so it really gives you the best of both worlds. You don't have to time the market, but you still get the benefit of those lower prices, holding some cash back as well to invest later on. So it's going to take that stress out of the market timing, and it's going to put more certainty in it. So I really do think you need that formal strategy of when you're going to invest, how much you're going to invest, and what you're going to invest in, so you can be watching for that. We're getting on about an hour and 15 minutes into this, so I'm going to shut it off here. Thank you again for everybody joining us here. If I didn't see your question, please ask it in the comments below, and I'll try to get to it later on today.